Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Well, we're about halfway through reporting season, perhaps a little beyond that, so we thought we'd check in with Matthew Kidman. Matthew is principal at Centennial Asset Management, and it's always worthwhile finding out what he likes and what he doesn't like, and where the opportunities might lie in the listed sector. Matthew, welcome back to Fear and Greed.
Hi, Sean.
Have you enjoyed the earnings season so far?
Not really. It's been quite tough. As you pointed out, there is a number of issues hanging around reporting season that the companies are telling us about that we already knew about. But when the companies tell you that things aren't quite right or things are tough, then it hits home a bit more because the share price moves quite aggressively.
Yeah, I mean, so we'll get onto those issues in a moment. And I know you're always one that you say, don't worry about what the share price does on the day because there's a lot of algorithmic trading going on and it settles down. But there have been some big moves in share prices of really big companies.
Yeah, we've had to adjust to that phenomenon over the years that no matter what a company reports, there will be a movement on day one. Like there's a little company that we had a shareholding in and we still do and we're quite happy with called Money3. It lends money basically for people who are buying cars that the banks won't touch. And they came out and they actually slightly upgraded their numbers. Their outlook was quite positive, but for some reason it was down 6% on the day. The subsequent day it was up 5%, and we're sitting close to where we were when we started the whole process. So those kind of things happen. We've had to get used to that.
Okay. So what about some of the themes, sort of inflation or input costs and prices? That seems to be flowing through a lot of the companies.
Yeah, there's some economic themes, and you've hit upon it. Like Amcor came out early and told us, and they said, we'll make our numbers, but don't make no mistake, things are quite tough, supply chain costs, and they said we are about to lift all our prices again for our various products, our packaging products. So they were the first cab off the rank, and of course we've seen companies like Ansell come out, and they pre-warned, but there's definitely a problem there. And anyone who's moving goods around the globe, that's an issue. Strangely enough, the issue around shortages of labour, which really struck home in Australia before Christmas, has probably eased a little. That's my feeling, that things aren't quite as bad. Companies have, one, put in processes to maybe cope with it, and two, the actual alleviation, one around just a shortage of labour and strong demand before Christmas, but then Omicron came along and that knocked the demand around. But then you had the problem of people actually having Omicron and close contacts. That now seems to be easing as well. So there's a little bit of light at the end of the tunnel there.
Yeah, I mean, it's interesting on the labour shortage because I'm just trying to think back. BHP talked about it in a Western Australia sense, but outside the state border closure, we actually haven't heard a lot about that.
No, there's definitely companies like Ingham's came out early and they just said straight out, and Woolworths have had the same issue. But I think that's easing now as the virus, rose strongly probably over Christmas, New Year's, and eased through the back end of January. We're probably okay. I think the other theme coming out of the reporting season was a market theme as opposed to an economic theme. All those issues are bubbling around. But I don't think I've seen a reporting season where expectations have played such a strong role leading into results. And you mentioned one a bit earlier, CSL. CSL's been falling for the best part of 6 months. It's one of Australia's biggest companies. It's been a darling of the market, a terrific company, global company. But in the 6 months leading up to its result, it kind of lost about $60 or $70, say circa 20%, as the issues around blood collection and a few other company-based issues around the globe, blood collection's become a lot harder for them, which is obviously, that's their inventory. And that became a lot harder. But when the result came out, guess what? It wasn't quite as bad as what the market thought. It wasn't great. Those issues were relevant, but it wasn't quite as bad. And bang, up 10% in 2 days. That's been a theme all the way through. You've seen the banks. The banks have got issues with their net interest margins, and there was a lot of negativity leading in. And guess what? The net interest margins did decline, but not as much probably as what the market thought. And for the main, they've gone up, ANZ probably being the outlier. I mean, even Bendigo Bank, which is, the super regional, has been much maligned. It's been a terrible performer, but it's really rallied hard. So you've had a number of those companies that previously not loved by the market, but found their feet, while some of the market darlings have been treated with very little respect. IDP Education being one of them. Everyone wanted the great education global company to perform strongly. It was a little bit off the mark, and bang, they've sold that. REA, very strong result, but said, hey, this half's going to be tough. We've got an election. We had Omicron. Let's just see how it goes. They've been cautious. They've sold that. So the darlings have been thrown out, and probably some of the unloves have been picked up.
The one that buy now, pay later sector, which I must say I've always been a skeptic on, some of those stocks have really been sold down hard.
That's an interesting subject in itself, because 2 years ago, it was just every other day there was a new BNPL product coming to market.
Yep.
People couldn't get enough of them. They were oversubscribed. The bellwether of the industry, Afterpay, was just surging high. This is post the first sell-off with coronavirus. But now the market's changed, and we know that's changed. With the pushing up of market rates and soon to be official rates, what you've seen is a lot of those non or unprofitable companies being sold off. And that's been going on in the US for 6 or maybe even closer to 12 months. Now, in the last few months, it's really struck home to that sector, because none of them really made money. And guess what? They need capital to grow. Really, what they're doing is lending money. So if you're going to lend money, you've got to have money to lend. And therefore, to grow, you need the capital. And the capital is drying up. So watch that space. Afterpay's gone off and married up with Square in the US. Probably a good move, good timing. But some of the others that are based in Australia, it'll be interesting to see if they can get through this next 12 months when the capital won't be there and the growth will slow, and they'll have to adjust enormously to make it through.
Stay with me, Matthew. We'll be back in a minute. My guest this morning is Matthew Kidman, Principal at Centennial Asset Management. So on the resources sector, if we go to the big materials companies, the miners, BHP had a cracking result, for example, but kind of very mixed. Newcrest was poor, even notwithstanding commodity prices in some ways.
Yeah, BHP has been a standout so far. Obviously, we're not through the whole reporting season. Smaller iron ore operators, Min Resources, and even Fortescue disappointed the market a lot. It's been hard to get the production right, despite the prices being strong. BHP, on the other hand, just hit every ball out of the park, and we saw them pay a bigger dividend. We saw their balance sheet debt come down. We saw a huge profit number. It was an outstanding result. But the unfortunate thing for BHP, it's not the result that we've just seen that will matter too much. It's that iron ore price and where oil and gas goes. And sure enough, that will get more towards iron ore as they hive off their oil and gas assets to Woodside. So it was interesting. It was a terrific result, but it wasn't across the board. We had S32 in the mining sector, more general base metals. That people like that. That looks strong. And some of the darlings, say in the lithium sector, the results don't matter so much, but they've found that they're going hard in recent times as well. So the market is very jittery.
Yeah.
And you asked me a bit earlier, where would you go in this market? I don't think anyone's really clear. You definitely don't want to be overweight unprofitable tech companies, but we've known that for a long time. And where the market's tried to hide in this last little bit is at the big end and in companies that are probably a bit unloved and a bit forgotten. So Wesfarmers, which was a darling of the market last year, nice big company that we can all associate with, a staple in anyone's portfolio, it was a bit soft. It's got some issues now compared to where it was, sold off. Banks, as I said, people have hid in there. Even Macquarie Bank had a terrific result and it was a lot better than anyone thought. But do you stay there? Because it tracks the market in general, because that's what it's playing. So very confusing time. Unfortunately, I'd love to say to you, this is where you go at this point in time, but we're in a real state of flux.
Yeah. Okay. I just do want to ask about the energy and the oil and gas guys, because we saw the big Origin Energy and AGL both bring forward the closure of coal-fired power stations. Woodside and Santos both came out in great numbers on the back of incredibly high prices. How do you invest in that sector at the moment, given the global trend towards green? And we kind of know that coal will be transitioned out. We think gas will be the transition energy. Renewables are the future, but that's not going to happen tomorrow, that's for sure. How do you think about sort of energy and oil and gas?
Well, the interesting thing, the move towards renewables is being accelerated by the fact that some of the old ways of making power, especially coal, are not cutting it anymore. And we saw Origin come out and say, well, we've got to close early. This is going to burn a hole in our pocket. Yep. The big retailers, AGL and Origin, are quite interesting because they've been in the doghouse for a couple of years, but their share prices have turned, and it's coming with a little bit more clarity around energy getting to market. In other words, what kind of energy, the alternative energy, the green energy now is, it seems, to be having a grip and being more broad. It's just not a supplement anymore. So I would watch that very closely. I think it's early doors for them. But it looks like maybe the worst is behind them in this transition, which, it's been a big upheaval from one sort of energy to the next and what it means for prices and so on. And we've seen prices move around, retail prices everywhere. In terms of the downstream guys who actually produce the oil, it's a really hard one. If you've been on it in the last 12 months, you're a winner. Well done to everyone who did that. But now you get the feeling that there is a fair bit of trading going on. The traders have got hold of the oil price, and that makes sense because we've got geopolitical tensions definitely in Europe. That's right on our doorstep, and we know how important that is to European energy prices with the Ukraine and Russia. And then obviously what happens with China and Taiwan off the back of it. These have bubbled to the top. So I think that's a bit of a dangerous place to be just at this very point in time. And you ask how to play it, I'd stay away from it for the moment. I think a lot of the good work's been done in the oil producers.
Okay, and then just finally, Matthew, on small caps, one of your favourite areas. You've mentioned a few earlier on in this discussion. Stock specific, I presume.
Yeah, look, it's been very stock specific. The small caps overall have probably been slightly disappointing we're probably, I don't know, I know we're a fair way through February, but we've probably had slightly over half of the companies. It wouldn't be any more than that reported. Most companies have done all right. They've handled things quite well, but there's not an obvious trend. Some companies will do quite well, some won't. Like, for example, the mining services sector, we've for a long time had a holding in a company called Index, which supplies companies that drill for gold and other resources, various parts to them, and it's done incredibly well and put out a great result. The market was a bit ho-hum on it because it's expensive. Then you had NWH, another mining services company, more based in supplying the yellow equipment and various different other parts rather than drill parts. And it's been on the nose for a long time, but the result was reasonably strong, and despite labour shortages in WA, and it rallied. So it is definitely stock by stock. I think the small caps you've seen in general in the US have had a horrid time. They've fallen a lot further with the prospect of higher interest rates and inflation. I think you're probably going to do it tough in that end of the market. People, as we grind through this interest rate cycle, people are going to migrate towards bigger, more liquid companies that have stronger franchises. Mm-hmm. That doesn't mean that there won't be the odd small cap that does really well, but I think it will be a far harder course for a lot of the small caps because investors will find it too hard.
Matthew, this earnings season, do you enjoy them? There's 2 a year.
Well, they're quite difficult for the reason we said at the top of the show, is that companies come out, we've been talking to them, and then they go into blackout, and the numbers come out, and you say, well, that looks all right. This is a bit better, this is a bit worse, okay. And the stock moves, and it doesn't move 1%. It moves 5, 6, sometimes 12, 13%. You spend a whole day going, well, what did we miss? Your anxiety levels are up. Sometimes they're up more, which is nice, and you walk around saying, well, I got that right. But when you look at it closely, there's not much different to what you thought. So it's just that volatility. The reporting season now is not so much an update about the company, but a trading event. And I think it's just the type of investors. And of course, it's a trend that's come out of the US where they have quarterly investing. But as a colleague said to me recently, it reminds him of the Japanese markets going back 20 years where the fund managers used to sit there with a book with all the forecasts and the expectations, and a beat would see it beat it, therefore it's up. It missed, therefore it's down. So it becomes this kind of gaming lottery type of scenario that you're at the track rather than let's have a look at the company. So it is a bit stressful, and it's not like it used to be, but that's the way it is. And over time, in between reporting season, markets work out what's what. So it's just the short period while you go through it.
It'll all be over soon. Matthew, thank you for talking to Fear and Greed.
Thanks for the counselling, Sean.
That was Matthew Kidman, Principal at Centennial Asset Management. This is a Fear and Greed daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.